Good morning. It's Friday, January 24th, about 5 a.m. Central Time. I joined CNBC's Worldwide Exchange this morning, covering all the commodity markets here. So no, I wasn't getting up early, getting after it, and shoveling that snow off the beach this morning. So had that priority to do, and it was a great segment, and we'll be sending it out to our clients. So overnight, the precious metals, they are surging after President Trump. He softened his stance towards tariffs on China. This comes following yesterday's sell-off and opportunity to add positions in the precious metals markets. Many of you new clients had added to silver after that 80-cent drop. Now, President Trump said he preferred not to have to impose tariffs on China. This helped push global stocks up to new record highs. Emerging market currencies are on track for their best week since July of 2023. So looking at the overnight price action in precious metals and the industrial metals, we got gold up about 3% this week, mainly on that safe haven buying and the uncertainty over the global economic outlook following the new U.S. administration. Tariffs should benefit gold, and this comes despite the accompanying rise expected in the dollar index. Now, gold did set some record highs last year as the Fed starts to pivot and cut rates, also geopolitical tensions and central bank buying. We expect all those to continue to follow into 2025 and expect gold futures to reach new all-time and record highs. So looking at the precious metals and the other ones, your best performing commodity here today, besides orange juice and sugar, it's going to be the silver market, up about 1.7%. Silver futures recapturing the 31 handle, sitting at $31.35, just off the high of the overnight session. Big bounce off that 30.82 level. And something to note yesterday was a lot of the dialogue that was coming out, specifically when Trump was speaking at Davos here via a Zoom link, he had indicated that they're really taking this stance on the European Union, Canada, and also Mexico in softening that stance against China. And what we saw was throughout the session yesterday, copper futures were lifting up, went positive on the day, and that was really your cue to look at the silver market. A lot of these markets, remember, they are global, they are dynamic, and they are all interconnected. You want to look at correlations between different commodities, and really silver and copper yesterday, those were the two that really shined here. So looking at the other markets, and also that gold-silver ratio still sitting at about 88, 89 to 1. So silver, in my opinion, is still dramatically undervalued in correlation towards that silver market. You have aluminum futures surging, you have platinum futures recovering, you have palladium futures back over that 1,000 mark. Now looking at some other markets here and shifting the focus to the U.S. equity markets, we are seeing a small breather here in the NASDAQ as there were downgrades from Bank of America on their price outlook on Apple, and then also the S&P 500, that's the one that's really pushing up here because of the fact that with deregulations, you're seeing a broadening of the stocks that are lifting up, and it's not necessarily that concentration that we were seeing in the tech sector specifically. Now back to copper, it is one of our favorite metals in the complex here, and it often acts as a leading indicator for inflation and also the economy. Remember that EV vehicles use 4 times more copper than traditional gas vehicles, and AI energy intense computing, which is expected to increase copper demand by about 3.4 tons per year going out to 2050. There's a lot of discussion about the grid, renewable technologies. Also, we expect traditional demand to pick up in 2025. Construction, infrastructure spending, and defense. China's demand is really shifting from this property sector. Remember, they were really concerned about the property sector and the decline. Now it's shifting more towards manufacturing and also new technology. You look at the crude oil market here, up about 4.5% year to date. We did see crude oil fall about 1.6% yesterday following Trump's comments. He's really expecting to have high production and low prices, which is achievable, but the complications come in when you implement a hard stance on China and maximum sanctions on Russia. Remember, Iran is the seventh largest producer, and Russia is the third largest producer. Now, ironically, every time Trump tweeted last time in his last back when he was president number 45, every single time he tweeted about oil, it fell about $1 to $2. So what I'm telling you is that if you hear that Trump is coming on TV, you probably want to rethink your positioning, because he's probably going to say something about the oil market, getting gas down, getting inflation down, and that the Federal Reserve needs to cut rates. And that's where we've seen these $1 to $2 drops on that oil market. So I'm just telling you to be a little bit cautious, especially if you have tighter stops in that market here. You don't want to give it up on just one tweet here. So now, the question is, back on the oil, is how fast can we increase production, and at what price is Trump comfortable with? So we'll probably see these prices trend down to the 70 to 72 level, and then how it trades around there is its critical level of support. Once they do announce the deregulations, that's when it really opens up the door for something in the mid 60s. I'm not bearish on the oil market. I just want to present to you what the possibilities of that oil market are, especially if we see this breakdown in prices. If you'd like to get a trial of our energy update that we send out every day to our clients, send an email to info@Blue Line Futures. Now, shifting to some of the agricultural markets, we did see the grain markets all rally here as China had tried to secure inventories ahead of any kind of tariff announcements. With the softer stance, maybe China might not be as aggressive on the buying, and also a lot of farmers are coming in and starting their hedging. Looking at the dollar index, down about 50 basis points right now, or 50 ticks at the moment, and all your foreign currencies are rising. The only one that's not is the Japanese yen here, and they did increase rates, which was widely expected. Now back to the CME's Fed Watch tool and where interest rates are going, because we do have to pay attention to this. I think that part of the tailwind we're seeing in the gold market right now is, if you look at the CME's Fed Watch tool, now you're going to get all the meetings going out into 2026. And where there was no chance of an interest rate cut at the January meeting, all of a sudden March has a 28% chance of a cut. May is pulling forward as well with about a 47, and then you go out to June, it is a larger cut here with a 75% chance. So what I'm telling you is that there were no interest rate cuts expected going out to the back half of the year. Now all of a sudden those are being pulled forward, and what it does is it accelerates the rise in the gold market. If all of a sudden things start to heat up, like the economic data and also the inflation data, you may see gold futures stall out near those all-time highs. Looking at the data that's coming out here today, we do have flash manufacturing PMI, flash services PMI, existing home sales, and then you have University of Michigan, the consumer sentiment, and the inflation expectations. So if you got any questions, if you'd like to open up an account, it's very easy. It takes about 5 to 10 minutes to do online. Shoot an email to info@bluelinefutures.com. We'll send you over the link to open up an online application. And then if you have any questions, reach out to us at 312-858-7303. Remember, futures and option trading does involve risk of loss, and it may not be suitable to all investors. Good luck, good trading.